All right, we are now at part C of lecture 32, Britain and a Gold Exchange Standard of the 1920s. Parts of this lecture may appear a bit technical, okay? But I hope by the end of it you'll see the importance of it because it plays, what I'm about to talk about, while technical to some degree, plays a really big role in the British economy, but also in the American economy in the 1920s. Now, you'll recall during World War I, again, all European nations left the gold standard. Only the US remained on the gold standard. And basically what we have is this collection of fiat paper currencies that have depreciated in value. The British pound fares the best, but the pound still declined by about a third in value. So there's the Union Jack, victorious in the war, but where do we go from here? Where do we go from here? And of course, this question applies to really every part of society after World War I. The post-war society was a very, there's so much disillusionment going on after that hellish experience of the war. But regarding the currency, this is a big question for Britain. What do we do with the currency after World War I? The British economy and the British currency system is basically in shambles after the war is concluded. And, it's certainly not what it used to be. Before 1913, Britain was firmly on the gold standard. This is an old sovereign, British sovereign, a sovereign gold coin, which was a £1 coin from 1911. British banknotes were redeemable in gold on demand by anybody in Britain. Gold coin was prolific. And this was the exchange rate. Right, £1 sterling, this is a pound coin, was convertible into, equaled, essentially, just shy of a quarter of an ounce of gold. A quarter of an ounce of gold. Or, if you want to put it in terms of dollars instead of gold, £1 sterling equaled $4.86. So, in other words, if you were an American citizen and you traveled to Britain, okay, you traveled to London in 1912, and you wanted to convert your dollars into pounds, to get a pound, you needed $4.86, and probably closer to $5 because you had to pay a broker. So that was the exchange rate. Now, Britain's off the gold standard. U.S. remains on the gold standard. U.S. has, a stronger currency now. The British pound is greatly weakened. And in fact, by 1920, the market value of the pound, what the exchange rate on the market, the floating exchange rate, has now fallen by 35%, so that if you were an American and you traveled to London and you had dollars and you needed to convert your money, now all you needed was $3.50 to buy a pound. Right? This is an inconvertible note now. So a pound sterling ain't worth what it used to be. It's a weaker currency now. And instead of being exchangeable into a quarter of an ounce of gold, now the most gold you could get out of it is 0.17 ounces. And that's not at the bank counter either. That would be in the marketplace, right? That is the market value of a pound now. So it's gone down quite a bit. So the question of what to do is looming large. But there are a lot of people in Britain after the war who have this deep desire, this nostalgic yearning to return to the old classical gold standard in Britain, to restore the once mighty pound sterling. The pound sterling was always the strongest currency, the hardest currency. And hey, we won the war. We ought to return back, many of these proponents say, back to that old glory of a strong pound. And what that means, these proponents say, is that we need to retain that old exchange rate, $4.86, or in other words, a quarter of an ounce of gold. And sure enough, in 1920, Britain announces that it will return to gold redemption once again in 5 years. So the date that they plan to return to a gold standard, 1925, will be the year. And they announce that they would like to do it. The intention is to return to a gold standard at this old ratio, the old classical ratio of 1/4 of an ounce of gold. The problem is that's not what a pound is actually worth now. The pounds have been so inflated. There's probably at this point double the number of paper pounds that there were during the war on the same amount of gold reserves. So it's pretty clear you're not going to be able to support the pound sterling at the old ratio. All right? The market value of the pound is only $3.50. By the way, at this low point, it was actually like $3.20, $3.40. But by 1920, it was about $3.50. It went barely back up again. But so, in other words, if Britain returns to a gold standard at this rate, that is a highly, highly overvalued pound. Meaning what? That the pound sterling, the British currency, the British pound, according to the government, has way more value inside of Britain than it actually does. Right? The British government is overvaluing the pound. What does this mean? Overvalued pound. And what is undervalued? What is undervalued is gold. Gold is undervalued because what they're saying is, the pound, it's worth 1/4 of an ounce of gold, when in reality, it's actually only worth 0.17 ounces. Gold is undervalued. The British pound will be overvalued. What do we have here? Gresham's Law. Gresham's Law. Good old Thomas Gresham. He's back. By the way, he'll reappear before the semester is over. Thomas Gresham, you remember, bad money chases out good money. Bad money chases out good money. Well, if Britain goes ahead with this, at this old ratio, the British pound is the bad money because it's overvalued. It doesn't quite have this value that the British government is claiming that it has. And the undervalued money, the good money, is gold or U.S. dollars. If there are any U.S. dollars in England, in bank vaults or just Englishmen, travelers who have dollars, it's not, that's an undervalued dollar inside of Britain. And so dollars won't be spent in Britain to purchase exported goods. But Gresham's Law, so that's what's at stake. And that latter point I made about the dollar being undervalued in Britain as well as gold being undervalued, one feature of overvaluing your currency. When you overvalue your currency, it ends up creating major trade deficits. Trade deficits. Why is this? Well, if the Brits overvalue their pound, what that means is if you live outside of the United Kingdom and you have gold or dollars, both of which are undervalued in Britain, are you going to take that undervalued money, gold or dollars, bring it to Britain to exchange, to convert into pounds in order to buy British goods? No, you're not, right? Because your money, your dollar and your gold will do better elsewhere. It's undervalued in Britain. And so you take your dollars, you take your gold to other countries instead, like Germany or France or wherever, and you buy their goods. Exports are discouraged by an overvalued currency because exports are artificially expensive. On the flip side, imports are encouraged. Imports are comparatively cheap compared to the high price for domestic goods within Britain with this overvalued currency. If you're an Englishman and you have British pounds, there's an incentive there because your British pound is overvalued. There's an incentive to take your pound and to buy dollars and gold at the $4.86 rate, and then take those dollars and gold, export them out of the country to buy imported goods, or to buy goods on the European continent or in the United States, and then to bring them back into Britain because imports are comparatively cheap. All right. If it sounds technical, it's a bit technical, but it's very, very important. And it had huge consequences for the British economy. By the way, if you hear of a country undervaluing its currency, like, for example, China has been a notoriously participating in that, manipulating its currency to undervalue its currency, you have the opposite effect, where you have big trade surpluses, where exports are encouraged and imports are discouraged. So, again, 486, the pound would be heavily overvalued with all the effects I described, gold being shipped out of the country, heavy trade deficits, unless the Bank of England contracts the paper money supply, right? So if the Bank of England takes a really big step and just hikes up interest rates to an astronomical degree and withdrawals just millions and millions of pounds of paper money from circulation, that's going to cause the market value of a pound to start to rise again. And then you might approach $4.86 at the market, and then it's no longer overvalued. The problem with that is it would involve just intense deflation, just huge withdrawal of paper currency from the economy, with all the effects of that, just spiked interest rates, which means little credit, prices and wages would have to go down. Britain by this point is heavily unionized, and so it's just, that's not going to happen. That's not going to happen. So they don't end up going with this option. The second option to perhaps mitigate some of the worst effects of this overvalued currency is to persuade other countries, especially the United States, to devalue their currencies, okay? To depreciate their currency, so that, you know, even if the Bank of England isn't able to change this by contracting its currency issue, perhaps the Federal Reserve, especially the New York Fed, can inflate its currency supplies so that the dollar begins losing value, so that 1 pound sterling will begin to approach $4.86 in the market that way. So you could have it both ways. Either the Bank of England's got to contract its currency, or the Federal Reserve has to inflate its currency. And as things so had it, the head of the Federal Reserve Bank of New York, Benjamin Strong Jr., coordinates with the Bank of England throughout the 1920s. The Morgans long had a strong relationship with the British Treasury and with the Bank of England, coordinated with the Bank of England to lower interest rates in the 1920s to slightly weaken the dollar. Now, it doesn't succeed in the sense that the Fed does not inflate enough to overcome or to counter the severe overvaluation of the British pound after World War I. So it doesn't quite work. But you look at here's a chart of the discount rate at the New York Fed between 1921 and 1928. And you see this here, and it was just a constant story of lowering rates. Had a little bit of a rise here, and then further lowering of rates. Well, 1925 is coming. So Britain hasn't made this switch back to a gold standard yet. 1925 comes, and the Chancellor of the Exchequer is none other than Winston Churchill. Winston Churchill, and here's a picture of Winston Churchill from the late 1920s. And Winston Churchill considers this question. He's in a top ministerial position, the Chancellor of the Exchequer. Should we do what was planned back in 1920 and resume the gold standard at that $4.86 rate? Churchill wavers a bit. He actually consults John Maynard Keynes, and Keynes opposes it. He doesn't want to go back to the gold standard. He thinks gold is a, quote, barbarous relic, and opposes this move. Churchill, however, ends up deciding to go forward with it, and in 1925, the Gold Standard Act restores the gold standard to Britain, but it's not the same. It's not the same as the old gold standard. Besides the fact that that the pound is very overvalued at $4.86 a pound. Besides that fact, it's not a full gold standard. According to the Gold Standard Act, British people, just ordinary men and women, did not have the right to simply, go to a bank counter and redeem their notes for gold. Notes are no longer redeemable in gold, and gold coin will not be used anymore. Gold coin will no longer be used domestically within Britain, and in fact, never again will gold coin be used domestically in Britain. Only paper notes, Bank of England, and some treasury notes. So how's this a gold standard? Well, there was a limited redemption allowed at that exchange rate, the $4.86, quarter of an ounce of gold exchange rate. That redemption is allowed, but only for international traders, only for foreign central banks. Okay, and even then, for an international trader or a foreign central bank to convert British pounds into gold, it had to be a large amount. Talking about thousands of pounds worth of money. The minimum was actually 400 ounces of gold. And the exchange was done with gold bars, gold bullion bars, not with gold coins. So it's a pseudo gold standard. There's no gold coin. There's no regular ordinary redemption for most people. So there's a Bank of England note, December 1925. So Britain returns to a gold standard, however weak it truly was. What about the rest of Europe? Well, Britain persuades other European countries, beginning with France in 1926, in Italy in 1927, and in most other European nations, including Germany in 1928. Britain persuades European central banks to also adopt a similar type of system, okay, where no more gold coin used in domestic circulation, and ordinary people won't be able to redeem their paper notes for gold anymore. And so what happened in Europe, beginning in 1925 through 1931, it collapses with the Great Depression. European central banks keep their reserves not in gold, but in British pounds. The British pound became the reserve currency. The reserve currency, it's going to be an important term soon when we talk about the US dollar being the world's reserve currency. British pound will be the reserve currency where European central banks in France and Germany, all over the continent, will keep their reserves not in gold but in British pounds, and then as they accumulate these British pounds, will pyramid their own money creation on top of those pounds. So in a way you could say the European national currencies were pegged to the pound. Okay, pegged to the pound, and then those British pounds, the European Central Bank, if they wanted to, could present to London for gold at the rate of £1 will give them just shy of a quarter of an ounce of gold. All right. Nevertheless, even though they had this ability to take those British pounds in their reserves and convert them into gold, there was a disincentive for them to do that, because those British pounds were the basis on which they could pyramid their own money creation, right? So most of the central banks, they didn't really want to remove their sterling balances, their British pounds from their reserves and present them for gold, because British pounds were serving them a pretty good purpose. That's how they were able to expand their own currency, expand their own credit. By the way, some of these European central banks also kept US dollars in reserve. So British pounds and US dollars, because both of these were convertible into gold. This made the British pound and the US dollar reserve currencies, currencies held by central banks as a way to give support to their own national currencies. In this system, economists call the gold exchange standard. The gold exchange standard, where gold coin is no longer used by any of these European countries. The only gold that's involved is gold bullion. There's a bunch of bars of gold bullion, and even then only for international payments, right? Settling balances. This replaces the classical gold standard. The classical gold standard is done in Europe and in Britain in the 1920s, never to return again. So this is a 1927 note from the Bank of France, 100 francs. Really cool note. You get some Art Deco going on there. But these notes, you can't go to the Bank of France and redeem them for gold, right? But the Bank of France has lots of British pounds in a reserve and is holding them as a way to give some sort of support to the franc. Keep in mind, as this is going on, the U.S. remains on the gold standard. This note still says the United States of America will pay to the bearer on demand $20. So you could take this $20 note, take it to the U.S. Treasury in Washington, D.C., and receive this coin, right? And in fact, gold coins are in circulation in the United States in the 1920s. This is a double eagle, $20 gold coin in the U.S. from 1925, right? But this is solely the U.S. now. Europe is no longer on this system. So, what a bit of a bizarre system. The British pound, heavily overvalued. So what happened after 1925? Because this overvalued pound, gold began leaving Britain, exported from Britain, and the trade deficit was really, really bad. Britain's trade deficit was very bad. It was actually, this move was very, very harmful for British exports. And the British coal industry in particular, but also British textiles, did very poorly during this period because the currency was basically stacked against British exports. And as these trade deficits continued, what that meant was British pounds were accumulating overseas. And other central banks like the Bank of France, the Reichsbank in Germany, are accumulating more and more British pounds. Their sterling balances are increasing. And by 1927, the Bank of France is beginning to approach London and say, hey, we need to make sure that this is convertible into gold, and beginning to present their British pounds to London for gold redemption at this overvalued price. And so more and more by 1927, 1928, this is putting quite a strain on the Bank of England. In fact, in 1927, there was a private meeting between Benjamin Strong Jr. and the head of the Bank of England. And Benjamin Strong actually agreed at that meeting to lower the discount rate at the New York Fed as a way to sort of give some support to the British pound by devaluing the dollar just a little bit. But again, it wasn't enough, and it was too little, too late. But you see this here in 1927, there was a bit of a dip. That was a result of British concern over the ailing pound as the Bank of France began redeeming some of those notes. Later, the New York Fed is going to have to start to increase interest rates a little bit again on the eve of the Great Depression. But yeah, so a bit of a technical part C of Lecture 32 here, but it had a really big impact. And I mean, for Lecture 33, we're going to see the Roaring 20s, right? Before we get to the Great Depression, the Roaring 20s, very, very prosperous decade economically for the United States. Not so for the UK. The 1920s was not a prosperous decade for the United Kingdom. Unemployment was quite high. Unemployment in the U.S. in the 1920s was about 2 to 3%. In Britain, it's hovering around 8%. Sometimes more, sometimes a little less. But major strikes, the export industry just did quite poorly in the 1920s. And a big reason for that was this foolish monetary policy that was pursued by the British government. So next time, Lecture 33, we're going to return back to the United States. We're going to look at the Roaring 20s and the Great Depression. It's going to be a jam-packed lecture. See you there. Bye.